Taxes are one of the largest ongoing expenses you'll pay each year, and the nature of our tax system is such that the more money you make, likely the more you pay in taxes. So the question then being, what are some ways I can reduce or mitigate my taxes, especially if I'm a high-income earner? On today's video, we're going to talk through just that. We're going to specifically address health savings accounts and how they can be utilized in tandem with a high-deductible healthcare plan to not only reduce your taxes in the present day, but to build wealth over time. Hey, I'm Scott Sturgeon, Senior Wealth Advisor and founder of Oriad Wealth Partners. If you haven't heard of us, by all means, check us out. Links below in the description. But today, like we mentioned, we're going to talk through HSAs and how basically we can reduce taxes today. Really, the way this strategy works is relatively straightforward, and it's even more impactful the more or the higher your income is, which is kind of a cool concept. So I guess really to start, what is an HSA or a health savings account, and why might I implement that to reduce my taxes or build wealth? So a primer again on the nature of the U.S. tax code. We won't get too into the weeds. We want to keep this video interesting and moving along. By all means, not put you to sleep. Really, the way the tax code or structure works is that we have what are called tax brackets. And the more income you earn, you hit certain breakpoints that put you into higher brackets over time. The higher brackets you are in, the more within that bracket you are paying in taxes, or a higher percentage of your income you're paying in taxes. So if someone says, oh, I'm in the 35% bracket, well, they're not paying 35% in taxes, but they're probably on a certain dollar amount from dollar X income to dollar Y income. They're paying 35%. Maybe their what we call effective rate is somewhere in the 20s, 25% or 21%, somewhere in that range. The use of a health savings account and the benefit that it provides is in what we call a triple tax advantage. So first, money that's contributed to an HSA or a health savings account is immediately deductible in the year that those contributions are made. So if you contribute, if you're married and you and your spouse or your family are all utilizing a health savings account, any of those dollars are immediately deductible. So if it's $7,000 you contribute into the HSA, boom, immediately $7,000 that are deductible for you. And so under that kind of current structure of taxes that we're in, the higher your income, the more impactful that deduction becomes in the present day. So that's kind of triple tax advantage. That's tax advantage 1. Tax advantage 2 is that the dollars that are invested in an HSA can grow tax deferred or tax free potentially over time. That's unique to that account. You think of like a 401k or an IRA, a 403b, a lot of kind of workplace accounts where you put the money into the account, it then grows tax deferred or even potentially tax free if it's a Roth type account over time. The benefit then being is that any dividends or interest or any kind of capital gains that might be recognized as your portfolio grows are not immediately taxable to you in that year. And so you're basically able to kind of compound more quickly the value of your account over time by investing those HSA proceeds. That's probably the biggest caveat to all of that is a lot of people think of, oh, I put my money in my HSA, I then pull it out during that year to reimburse myself or to pay for medical expenses as I incur them. I would suggest to you that actually a more effective route potentially could be instead investing those proceeds, allowing that balance to compound over time and almost treating an HSA like another retirement account, almost like a healthcare specific retirement account. That brings us to really tax advantage number 3. The real benefit of an HSA is that not only again, you can make deductible contributions, those contributions can grow over time, tax deferred, but third, and maybe most importantly, you can withdraw those contributions or any potential growth in the account, not only in the present year to pay for medical expenses, but also to reimburse yourself for prior year medical expenses. So hypothetically, if in this year I incurred $5,000 in medical expenses and I hit my high deductible, I could save the receipts for those transactions and potentially reimburse myself $5,000 20 years from now for those costs, using whatever contributions I've made or the growth in my HSA to do that. You can also withdraw HSA, interestingly, you can withdraw HSA's contributions and funds in the account tax-free to reimburse yourself for Medicare premiums as well. So it's kind of like an added benefit. And really, all of those are tax-free. As long as it's a qualified medical expense, the IRS lists out what those are. As long as those are required expenses, boom, tax-free to you. So that's that triple tax advantage. Again, contributions tax deducted, the amounts held in the account as they grow or invested are tax-free. There's no ongoing income tax payments required for those. And third, and maybe most importantly, withdrawals from the account are tax-free as well, as long as they are for those qualified expenses. Lastly, the question then being, well, what if my HSA gets so large and I don't have healthcare expenses to reimburse? No worries. An HSA can become more or less an IRA once you're in your 60s to allow you to basically withdraw any funds you want from the account. You'll pay income tax on them just like you would for an IRA, but it's not like you pay a penalty or the funds are locked up in perpetuity. So again, I treat it for clients that I work with just to rationalize it, encourage them to think through it like it's basically at a worst case scenario, it's an IRA. You're going to pay income taxes on the funds withdrawn. Best case scenario, it is literally kind of like tax. It's almost like government-funded healthcare when you kind of think about it, right? You're putting the money in, you get a tax benefit for doing that. The funds, grow over time, tax-free or tax-deferred, and then you're pulling it out tax-free as long as it's for qualified expenses. I mean, really, that's the huge benefit of having an HSA. So the caveat then, what are the catches for this? What do I need to be thinking about or looking out for? Obviously, you need to be saving receipts for medical expenses, which is a minor inconvenience, I will admit. People switching over from a PPO plan probably aren't used to doing that, and they're probably in tandem with that, not used to having much higher deductible on their healthcare expenses. So, your HSA or your high deductible healthcare plan might have deductibles in excess of $2,000, $3,000, $4,000 a year, whereas maybe a PPO plan at your employer might be a deductible half of that. You're saying, well, I don't want to pay several $1,000s more, which makes sense. But the kicker that you have to really think through is that it's all net of taxes, right? So any premiums you're paying into a PPO, you're immediately losing that money. You'll never get those premiums back. Whereas your HSA, your high deductible healthcare premiums potentially are lower, and in tandem, you're getting all the benefits of having access to that HSA, not only the ability, again, to receive tax deductions in the present day, but also grow those assets over time by investing that HSA as well. So lastly, is at the end of the day, is an HSA in tandem with a high deductible healthcare plan right for you? Probably the answer is going to vary dependent on your situation, but I would throw out a few kind of general screening questions I typically think through for clients. Number one, what does your health look like? If you are generally healthy and you're maybe not hitting your deductible every year, generally in my mind, that's going to lean more towards this strategy working well for you. Secondly, if you are in a high income tax bracket, more than often than not, I find at least, the HSA in tandem with a high deductible healthcare plan tends to work just because of the myriad of tax benefits that you receive for implementing the strategy. And then lastly, I think it's just kind of return on investment versus return on hassle, ROI versus ROH. That's like the bread and butter or the cornerstone of financial planning and really wealth management in general is, are you willing to put up with some amount of hassle to increase wealth, to increase the value of your investments? In this instance, yeah, you have to track potentially a few minor things or keep receipts. I use an online document store. I take a picture with my phone, immediately upload it to a file that it's held in the cloud somewhere, and I really don't worry about it too much. So not a huge hurdle, I think, in my mind. HSA accounts in general sometimes are a little more tricky, at least in moving money around or investing those accounts. I found in recent years that's less so than maybe it was 5 or 10 years ago. But at least I think a couple things to consider. So again, health savings accounts in tandem with a high deductible healthcare plan for high income earners that are in relatively good health. Really a strategy I think that's at least worth considering. If this is something that is at least kind of ringing some bells or kind of piques your curiosity, there's a scheduling link below. By all means, reach out and schedule some time with me, or subscribe to our newsletter, Views from the Top. It's also linked below. We put out content just like this, or kind of things to consider just like this on a bi-weekly basis. So again, thanks you for taking the time to again kind of talk through some tax strategies for high income earners. And if it's of interest, obviously scheduling some time, I'm more than happy to kind of consult with you and provide thoughts or feedback on kind of your current financial plans and how working together might more align to those finances with your goals. Again, I'm Scott Sturgeon, Senior Wealth Advisor for Oriad Wealth Partners. Thanks so much for tuning in.